Hello and welcome back to another episode of Control Cash, your no-nonsense guide to personal finance. Today we're tackling one of the biggest questions dividend investors face. Should you build wealth with dividend growth stocks or collect steady cash flow from high-yield income investments? On paper, one clearly wins over the long haul, but here's the catch. The right choice really depends on when you plan to retire. A portfolio built for someone retiring at 65 or 55 looks completely different from one built for someone chasing fire at 40. In this video, we'll break down the pros and cons of both strategies so you can decide which fits your goals. If you find this helpful, please make sure to like and subscribe for more. Getting right into it, let's compare two of my favorite dividend funds, SCHD and SPYI. First up, SCHD, which is the Schwab US Dividend Equity ETF. This is a dividend growth fund that tracks the Dow Jones US Dividend 100 Index. It pays quarterly dividends with a current yield around 3 to 3.5%. What makes SCHD so popular is its long track record of consistent dividend growth, strong capital appreciation, and rock-bottom expense ratio. It's one of those classic set-it-and-forget-it investments, perfect if you plan to build wealth over decades and retire at a traditional age. Now, on the other side, we have SPYI, which is the NEOS S&P 500 High Income ETF. This one's a newer fund, launched in August 2022, and it flips the strategy completely. Instead of focusing on dividend growth, SPYI generates big monthly payouts, currently yielding between 11 and 12% annually, by selling options on the S&P 500. In other words, it trades long-term growth for short-term income. That makes it especially appealing if you're aiming for fire or want to live off your portfolio sooner rather than later. With SPYI, you're not waiting until 65 to enjoy your dividends. You're getting those fat paychecks right now. In order to compare these two funds fairly, I ran the numbers through a drip calculator to track the hypothetical returns over time. Let's assume you start investing at age 25. Now, there are really two milestones to think about, retiring early at age 40 and retiring at a more traditional age of 55. By looking at these two scenarios, we can figure out which strategy, dividend growth or high yield income, works better for each type of investor. Think of it like this. Investor A wants to fire and walk away at 40. While investor B is playing the long game until 55. The numbers tell two very different stories. Let's start with investor A, who wants to retire at age 40. That gives them just 15 years to invest as aggressively as they can and replace their 9-to-5 income. If we load SCHD into a drip calculator, assuming $1,000 a month in savings and using SCHD's historical dividend and share price growth rates, here's what we get. After 15 years, investor A's portfolio grows to about $550,000. Generating nearly $30,000 a year in dividends. Pretty impressive. $500,000 in just 15 years? But here's the catch. That dividend income comes out to less than $3,000 a month, which isn't quite enough to fully walk away from a job. Now let's compare that to SPYI. Using the same $1,000 per month savings and factoring in zero growth and zero price appreciation, investor A ends up with a slightly smaller portfolio of about $509,000. But the game changer is the income. Over $57,000 a year in dividends, or about $4,800 a month. That's just about equal to the median full-time income in the United States, meaning investor A could realistically live off their portfolio and retire early. The conclusion here, if you're looking to retire early and live off your passive income before the traditional age, investing in high-income stocks is the way to go. Now let's take a look at investor B, someone planning to retire at age 55. Starting at 25, that gives them a 30-year runway to let compounding do the work. And with that extra time, investor B doesn't need to save as aggressively. Instead of $1,000 a month, they can invest just $500 a month and still build serious wealth. With SCHD, after 30 years, investor B ends up with a portfolio worth about $3.1 million and an annual income of roughly $264,000. That's more than enough to cover expenses and retire comfortably without touching the principal. Now let's compare that to SPYI. After 30 years of the same $500 per month, investor B's portfolio is worth just $1.8 million, producing $204,000 a year in dividends. So the income at retirement is still enough to retire off of, but the portfolio value is drastically different. The key takeaway, SCHD's dividend growth plus capital appreciation creates an extra $1.3 million in wealth over the long term. Both funds give investor B the income to retire, but SCHD builds a much larger nest egg for later in life. So what's the bottom line here? If you're chasing early retirement at 40, a high-yield fund like SPYI gives you the income to actually make it happen. SCHD simply doesn't pay enough in the short term, even though the portfolio value is solid. But if you're planning to retire later, say around 55, SCHD's dividend growth and long-term compounding pull ahead. You'll still have plenty of income to live on, and you'll end up with a much bigger portfolio overall. That's why there isn't a one-size-fits-all answer. The right choice between dividend growth and high-income investing really depends on when you plan to retire. High yield is about income now. Dividend growth is about wealth later. As always, diversification is always a great tip for investors who want a mix of high income now and long-term wealth later. Personally, I value time above everything else because you can always make more money. But once time is spent, there's no getting more of it. To me, there's no point in retiring with a massive fortune if I'm too old to do the things I wanted to do when I was younger. I would rather retire early and give up some long-term wealth to be able to enjoy the things I love earlier in life while I'm still healthy and active. So what strategy do you prefer? Let me know in the comment section below. If you found this video helpful in helping you plan out your retirement, be sure to like and subscribe for more videos on investing, dividends, and retirement planning. If you're exploring different types of dividend stocks, be sure to check out my videos on the top REITs and BDCs. Thanks for watching Control Cash, keep investing, keep stacking dividends, and I will see you for the next one.